Good afternoon, ladies and gentlemen. By my watch here, it is 12 noon, Lagos time. I'd like to welcome everyone to the PwC Oil and Gas webinar, Preserving Value in Challenging Times. My name is Cyril Adobu, partner and oil and gas and advisory leader at PwC. I'd like to welcome everyone to this webinar and all the participants as well as panelists drawn from across different sectors of the industry. Today we see the impact of the COVID-19 on the industry, twin shocks, mainly around significant declines in demand, plus supply gluts that has arisen from the failure of the OPEC Plus to reach consensus around supply cuts. And so this has really caused unprecedented pressure on the energy value chain. And we've also seen market instability and uncertainty, which also puts pressure on project finance, business sustainability, and generally puts threats on value preservation. So we're seeing a risk of value erosion, and companies are really struggling and may indeed struggle for some more time to come, given the situation we are facing. And that said, we may have seen this before during the Ebola crisis, but the situation we find today is really quite daunting in terms of its global impact. And we today are looking for considerations that oil and gas companies and players within the industry can take within the short term and the long term to preserve value. Today, we've seen oil and gas, particularly crude oil price, rise in a very modest manner, just a few dollars. But last week, we did see that Brent crude fell to its lowest in two decades, and before staging the modest recovery. So today we will be having a discussion. We have a very rich panelist, and my colleague Bisola would be moderating that session. I'd like to add here that first, this is being recorded, and this is to make sure that we have the recorded session available on our website, so participants and those who might be interested can pick on that and view and listen to that later. We will be having a panelist discussion, and prior to that, we'll have a presentation of Code Fast, one of my colleagues. The moderator would introduce her, and following which we'll have a panel session where various panelists will be responding to different issues and questions that may arise during the session. There is a question and answer tool that you can use to ask questions. It's available either on your laptop, depending on whatever you're using, whether you're using your laptop or your hand device. There is a tool that is for Q&A. You'll find it there as one of the tools or facilities within the webinar platform we're using this morning. So please feel free to ask your questions. Your questions will be taken and responded to. The moderator will coordinate all of that. Okay, at this point, I'd like to introduce Abisola Atitabi. Abisola Atitabi is an associate director in our oil and gas group within our assurance practice. She will be moderating this session, and I hand over to you. Bisola, over to you. Thank you.
Thank you very much, Cyril. Good afternoon, everyone. Thank you for joining us. I am Abisola. I'll be your moderator today. It promises to be an insightful session. To progress along, I'd like to call my colleague, Bola Adegun, an associate director in PwC Advisory Unit, to run through the current code facts of the industry, which will serve as a background to our discussion today. Over to you, Bola.
Thank you, everyone. Good afternoon. Thank you, Bisola, for the introduction. My job this afternoon is to take us through some cold facts, and then we go along. Like you'd expect, the impact of the COVID-19 globally and locally has been very, very massive. It has been a major disruptor for governments and economies. It led to lockdowns, social distancing, stay at home. Um, with particular reference to the oil and gas industry, it has led to two main shocks. Massive decline in the demand for jet fuel, like you would expect with almost non-existent air travel, global lockdowns. The demand for jet fuel has declined significantly. The second part of it is decline in demand for diesel and gasoline. Um, Again, tied to the COVID-19 pandemic, where you have a lot of people staying at home. So there's limited local transportation, limited industrial activities. This has resulted in also a major decline in demand for gasoline um, and demand for diesel. So, I mean, industry practitioners, there are some questions that they currently have in their minds to say, when would food prices go back to their pre-COVID-19 levels? When would demand go back to their pre-COVID-19 levels? What strategic initiatives should companies put in place now such that they're able to be resilient and absorb this shock even in the short term? And then lastly, is the industry still viable? Is the industry still able to attract investment? When you look at the cost of production, especially in Nigeria, you compare that to what the current prices are globally. There is the industry players even able to break even or make a margin? Some of these questions our highly esteemed panelists will try to address as we go along. Again, we can't set the stage for where we currently are without looking at how food price has declined to the point where it is currently. And a critical part of that is the inability of OPEC Plus Saudi production quota, which then resulted in a significant supply glut in the industry and, like you expect, it had an impact on food prices. And I mean, to demonstrate the supply demand disequilibrium, some analysts are predicting that at the height of the COVID-19 pandemic, the decline in demand for crude prices may be as high as 21 million barrels per day. That in itself is very, very significant, which shows that the industry is currently going through major uncertain times. And a large part of this decline is, like you would expect, tied to jet fuel. I mean, as at yesterday, British Airways, for instance, announced that they were going to lay off 30% of their workforce, 12,000 employees, because air travel is almost non-existent, and that has its impact on demand for jet fuel. So, I mean, bringing it further down to our local environment, right? At PwC, we are trying to look at the oil and gas value chain, upstream, midstream, and downstream, and to see what are the themes that we see amongst players, whether locally or internationally. In the upstream phase, we see significant market capitalization erosion, significant capex cost. We see significant staff reduction, rationalization. In the midstream, refining margins are almost non-existent. They've thinned out. So we find that some refinery projects that were erstwhile bankable are now being either put on hold or completely cancelled. In the downstream, we see that demand for refined products has declined significantly, again tied to working from home, stay at home, social distancing, lockdowns locally and globally. So, for instance, in the US market, the demand for refined products has declined by about 70%. So we see all these things play out across the energy value chain, the upstream, midstream, and downstream. When we bring this to our local market, Nigeria, we find that the picture becomes even more complex. And this is because Nigeria's cost per barrel is high when you compare this to other clients. And part of our analysis in PwC shows that about 70% of the cost per barrel in Nigeria is tied to production costs and gross taxes, which indicates that oil and gas producers in Nigeria have limited room to manage their margins. So having set this context, what then is the way forward? We see the way forward in two ways, the traditional way forward and the new way of thinking. We know that businesses have three main objectives in these uncertain times. One is to preserve their oil and gas business. Second is to grow their low carbon business. And lastly is to deliver returns to their shareholders. So how are they able to achieve all of these objectives in these uncertain times? In the traditional way, we see businesses emphasize on cost cutting, cost optimization. So in the traditional way, we see things like capex cuts, we see staff cuts, we see dividend cuts. That's in the traditional way. However, in the new way of thinking, how do we see businesses approaching these uncertain times? We categorize this across several spectrums. Number one, cash is king. So we see businesses focusing on their cash consumption. We see businesses paying attention to their working capital management. And that includes a detailed review of their business to ensure that there are limited cash leakages in their operating process. Another thing we see amongst businesses, locally and globally, is that they are building resilience in their operating model. So businesses are ensuring that they are resilient enough to be able to ameliorate the impact of these shocks on their going concern status. And part of that is using innovation and technology. So again, we see a lot of businesses automating their process so that they're able to be cost efficient, and they're able to take out excess fat that's not necessary. That may include laying off underperforming or non-essential staff. So we see businesses taking on innovation, technologies, building resilience. And then lastly, we see businesses using this opportunity, this uncertain times, to grow their energy transition plans, to grow their low carbon businesses. So I think that's my time. Thank you very much for listening. I hand over back to Bisola. Thank you again.
Thank you, Bola, for that context. I mean, the whole pattern is a big and good picture across the value chain of the industry, especially with the supply glut, the remarkably low levels of demand, and the high cost of production in Nigeria. In our panel discussion today, we'll focus on next steps, on solutions, on how the industry players can survive and preserve value at this time. As we start, I'd like to introduce the four panelists who are distinguished experts and leaders in the various subsectors of the industry who will do justice to this topic. I'd like to start with Mr. Umar Ajiya. He's the CFO of the Nigerian National Petroleum Corporation, NNPC. Prior to his appointment, Mr. Ajiya was the Managing Director of the Pipelines and Product Marketing Company, TPMC, as well as the corporation's DGM Corporate Planning and Strategy. Mr. Ajiya was the pioneer staff of the Nigerian LNG Limited. He rose to become the Marketing and Business Development Manager before he then joined NNPC. Mr. George Osawa is the Chairman of Energia Limited, an indigenous upstream oil and gas company and the joint venture operator of the Ebendo Bodeti Marginal Field. He was previously the Managing Director of MPDC and later became the GGM of the National Petroleum Investment Management Services, NAPIM. He retired from NNPC in 2009 as the GGM Nigerian Content Development, and he was also director at the Directorate of Petroleum Resources, DPR, from 2013 to 2016. Mr. Mahmoud Tucker is the CEO of Eternal PLC. He previously served as the MD CEO of Dado Maritime Services Limited. Is the Vice Chairman of Eco Marine Group, an Executive Director of Independent Energy Limited, an indigenous oil exploration and production company. IEL is the operator of the Offa Marginal Field. It sits on various companies as an independent director. And then we have Adrian Del Mastro. Adrian Del Mastro is the director in PwC UK. He's a global director of research and head of top leadership in energy for PwC Strategy, and he has worked with major oil and gas operators, oil servicing companies. He advises clients on a range of topics, including market entry strategy, growth strategy, M&A, target identification, and trends in digital technologies. I'd like to welcome my panelists. Thank you very much for joining us. Just before we start, we'll start with introductory remarks. We would explore a few questions before we take questions from the participants. So participants, please send in your questions and who you would like those questions to be posed to. So we'll start our panel discussion by looking at perspective. And I'll start with Adrian. Adrian, what is your perspective on value preservation at a global level?
So thank you very much for that introduction. And just before I respond, I just wanted to say a very big thank you to PwC Nigeria for organizing this event. It's absolutely essential that we should be engaging with our clients and helping them navigate these turbulent times. So thank you for that. And I hope that all the members of the panel, PwC Nigeria, and all the people joining this call, that their families and loved ones are safe and well in these difficult times. What I'd like to do is, talking about value preservation, I just thought it might be helpful to look at this question through three lenses. Briefly, a global lens. Secondly, the impact on Nigeria. And the third lens, looking at maybe some lessons learned across other geographies that might be helpful. Bola gave a very eloquent introduction to the global context. I'm going to stay light on this, but all I'd say is, we are seeing significant demand destruction across the industry, the likes of which we've never seen before. You saw from Bola's slides there, the IEA is talking about a 9 million barrels a day reduction in oil demand for 2020, the current forecast. But analysts are talking about much more aggressive levels of demand destruction just in the month of April alone, about 30 million barrels a day, which is about nearly a third of consumption before COVID-19. We have a lot of supply on the market, as you're aware, and clearly there is enormous demand for storage. So you're seeing storage companies charge very high rates. Think of oil tankers being anchored offshore, used for oil storage and for refined products. Think of terminals, pipelines. The industry is getting very creative about where they can store this oil and refined products where there is no demand, but there is a limit to our capacity. And some of the implications you will have seen last Monday when WTI went negative. Now, while that was a very symptomatic event for a particular grade of oil in a particular geography, I think it did send a message out to the market, help sharpen people's focus on what needs to be done. And perhaps the next step might be we might see increased shut-ins for production. In terms of the lens on Nigeria, you can already see the impact, Bonnie Light, in terms of that national marker, trading at about $3 to $5 discount per barrel. You're seeing production economics being challenged. You saw some of the data there, but very broadly speaking, we're talking about production economics in the range of around about $20, $22 a barrel against a much lower oil price. Cargoes are being challenged in terms of finding export markets. And you can appreciate that there is limited storage as well in Nigeria. And as in many other geographies, some of the operators have turned to the oil services companies and have sought reductions in price in terms of price optimization across the supply chain, ranging anywhere between 20 to 40%. What I would say now is we saw in the last oil price downturn of 2014 significant gain in terms of savings across the supply chain in that price downturn. And we saw savings in terms of price deflation and improved efficiency. I'm not so sure that we have the same scale of opportunity this time round. I think savings will be challenged. And perhaps the last point on the Nigerian context, clearly producers will be under enormous pressure to improve production economics and deal with this very distressing situation. The last comments, I just want to talk about briefly some lessons across different geographies that might be helpful. I think one important message is collaboration will be key. We saw that in the price downturn of 2014, in collaboration between operators, oil services companies to improve efficiency and to be much more innovative in dealing with the situation will be critical. A brief example, in the UK North Sea, there was an issue around ferrying infected workers with COVID-19 off offshore platforms. And a number of operators clubbed together to form a consortium to pay for a helicopter carrier to lift infected workers off the platform. You will see last year, there was a lot of focus on ESG, environmental, social, and governance. I think what's interesting in this crisis is you're seeing the oil and gas companies focusing a lot on the S, on the social. So think of, for example, examples where oil and gas companies are trying to help the community in the crisis. So Shell and BP using their retail outlets to provide food and essential items to be delivered to the elderly. Other oil and gas companies providing free fuel and services to emergency services. And even think of examples of petrochemical plants that have been reconfigured to produce other critical items such as sanitary gel for the crisis. So these are all good examples of oil and gas companies majoring on the social impact. I think that's pretty critical. And the last comment I will make before handing back over to Abisola is I think technology will be really important now and going forward. So if you think of the gains made in digital solutions following the 2014 oil price downturn, I think that rationale is going to be reinforced because digital offers the opportunities to increase efficiency and also to increase automation. If there's one of the elements of this black swan that has dawned on people is exposure to having physical workers physically handicapped through the impact of COVID-19. So I think digital implementation of digital technology will be extremely important going forward. I'll stop there and I'll pass back to you, Abisola.
Thank you so much, Adrian. So you focused on the issues that we're seeing and also looked at way forward, talking about collaboration and technology. I'll bring it down now to the Nigerian upstream sector. Mr. George, what is your perspective on value preservation and survival of the upstream players?
Thank you, Bisola. If I'm to put it succinctly, I would say that value preservation in the upstream sector of the Nigerian oil and gas industry is only achievable if operating companies do not stop production. Don't stop. While stakeholders, including government and linkage industry players, they work together to ensure sustenance of operation through this difficult time. And I'm going to look at preservation in three areas, from three angles. I'm going to look at assets, we're going to look at personnel, and we'll look at cash flow. On the asset, somehow you need to get to where your production is coming from. So you must be able to have access to your operational sites, be it platform, be it flow stations onshore. I'm sure you remember some days ago where some industry workers could not get to their location for one reason or the other. That should not happen. You need to call back on high-cost projects, especially drilling. And I'm sure you remember that quite a number of the major operating companies have called back on drilling operation and put all those things in abeyance until prices come up again. This, of course, is to preserve cash. And of course, because of the number of people basically working on a drilling platform, you don't want anybody to come in with any issues of COVID-19 transmission. Then the only thing is worry about anything that's going to ensure that your production continues. Now, on the personnel side, you must manage your crew change very, very effectively. Because if anything happens and you have issues of a breakout of COVID-19 on your operation, you're going to be in trouble. Then you need to sustain your staff. We know that it's going to be difficult for a number of companies to continue to pay salaries at the rate they are going right now. But of course, we are under the control of the DPR. The DPR says you cannot fire anybody without reference to me. We will continue to confer with them, but it is also better for you to carry your staff along as much as possible by not cutting salaries. But of course, you also need to train them so that they don't get obsolete and get bored, because you know the way it is. Then let's look at cash flow. That's the big one. The companies now have the opportunity of renegotiating quite a number of the debts they have. For those of them who are owing financial institutions and things. They will need to do that. They will need to renegotiate with their suppliers and service providers also. And just like Adrian said, companies are being asked to take as much as 40% cut. It is not unusual because that happened in 2008 and it also happened in 2014. So somehow the industry is more or less used to it. Then, if possible, I know it will be difficult in some areas, don't even worry about paying dividends, especially for the small operating companies. You just cannot afford it. And of course, the big one, which is, like they said, the big elephant in the room. How do the companies get across to government to cut down on the number of exactions in the industry? There are about 14 of them. These things need to be reduced to make the companies float. And let's look at the long term. The near total dependency of the government on crude oil sale is obviously not going to continue for too much longer. They need to do something about it so that at any time there's an issue like this, we know exactly what to do. For example, if you look at what happened with the refinery initiative, I call it refinery initiative because at the first time the government said, let's build refineries, people were not particularly interested. The second time around, quite a number of companies showed interest. And I'm not talking about the big refinery like that of Dangote. That is a good one, fantastic. But don't forget that just like cement, the nearer you are to the source of production, the cheaper it is for you. So you need as many refineries as possible, but not just refineries. Government needs to expand that. Look at urea plant, methanol plant, LNG, petrochemicals, even waste disposal, waste management. Focus on the oil and gas industry. They need to work on that. Then, taking a cue from what Adrian said, maybe most of the major operating companies and some small ones using the auspices of OPTS need to come together and look at possibility of establishing testing sites or locations so that people who are going offshore, just like you have the offshore safety permit, they also will be tested because if anything happens on your offshore platform, it's not going to be good. Then I think the last thing I'm going to talk about here is the industry has to embrace technology. Whether we like it or not, we must embrace technology in all areas, including and not limited to permits and approvals on the part of government. Things like unmanned platforms, subsea processing, we need to think about them going forward. And maybe one more point. Financial institutions should be very, very supportive. I'm probably going to talk about that later on, but they have to be supportive under these conditions. Thank you very much.
Thank you, Mr. Osano. What you said is don't stop production. Let the oil flow. Okay, Mr. Mahmoud, you focus on the downstream sector. What are your perspectives on value preservation focusing on sustainable business operations? Because Adrian had spoken about business operations. Mr. George has spoken about business operations. So what are your perspectives focusing on the downstream sector?
Thank you. Good morning and good afternoon. Thank you very much for having me on board. Downstream, we're typically the whipping boys. By the time upstream are finished enjoying whatever there is to enjoy, they leave the crumbs for us downstream. I think, reading something McKinsey said, they said basically, if your business model looks the same as it did at the beginning of the year, you are in denial and possibly out of business. And I think that's very apt for the downstream sector. We are facing an unprecedented crisis in Nigeria. We don't know whether to turn left or right. There are critical factors that are beyond our own direct control that affect us. And I speak for every single player, from companies who are large and integrated, who have trading positions, have storage, have retail outlets, to those who just own a truck or a petrol station. It's a global issue. And fundamentally, the most important actually is about cash preservation. So what's going to happen to our business? What priority for us? If you don't have cash, cash is king today. And the cash is to fund the business of yesterday, the business of today, and the business of tomorrow. And what do I mean by that? As you know, we import every liter of petroleum product, and that is FX dependent. Now, where the CBN has a 6-month lag of where you can actually bid where transactions qualify for FX allocations, it means technically your cash flow must be able to finance products which are 6 months old, inventory already sold, but positions remain open, current positions that you are trying to manage, as well as your receivables. So the impact of the business is who is going to be able to manage cash, who is going to be able to have access to cash at a cheap price to be able to survive in this business. We have to be aggressive in curbing spending, because that's really the key consideration for us. I think investments are going to dwindle for the moment. We probably have an overcapacity of assets in terms of depots, in terms of there's enough petrol stations to meet our local distribution requirements. So lines of credit, access to capital, seeking relief in terms of debt and restructuring of existing debt is very key. Communications is very important. We are used to our customers coming to us. So customers come to the stations and buy fuel. Is that model going to change with people working from home? The digital revolution, the old business model, because of sharp practices in the oil industry, was you would typically have a dealer, you run a station, you have a deposit from that dealer, and that sort of protects your cash flow. But then also means you're throwing away margin. So today, in terms of trying to protect your value and ensure that you maximize that value, you need technology, real time. Can you monitor sales? Can you monitor cash documents? Can you have a cheaper style workforce managing your operations on a day-to-day basis, so therefore you can cut your costs? And then what does the customer want? Convenience. So the business of tomorrow is beyond selling fuel. People require convenience. So that what we call non-fuel revenue is very essential. So we're very good at building petrol stations, but are we very good at selling value from those stations? I saw in Morocco, amazing people go to petrol stations and spend the whole day there, because not only can they buy their fuel, but of course there's restaurants there, there's amusement parks, there's playgrounds, there's places of worship. So that whole value chain around people's lives. Today we're sitting at home, it's Deliveroo or Conga or somebody, whoever it is that's delivering something to you. It's convenience. Everybody wants convenience. And how does that affect our business going forward? I think that's key. We need to be able to boost productivity through digitization and also manage our security network. In terms of how the business is evolving, of course, short term, everybody expects that prices have dropped globally, and therefore we should be able to enjoy better pricing in Nigeria. But the key risk is always the FX, and I think that's FX management is going to be the key for any downstream player. That's the major albatross in the room that we haven't been able to address. And of course, traders today, I saw yesterday, just looking at some of the Reuters reports, VLCCs have become the new norm for storage. So storage is king. Whoever has access to storage is king. And there is definitely a short-term arb in the market for those who can buy crude at a reduced price and hoping to sell in the futures, as well as obviously trading derivatives around those physical positions. Similarly, the demand for products has drastically falling across. People are not flying. People are not driving. So that demand, what's going to happen? Refineries are now having to cut back on their refining capacity. So that has a key impact. So therefore, whoever has storage is the king today. But of course, that storage itself is now becoming limited. So we've seen an exponential growth in the cost of storage. Now in Nigeria, that is now offshore. So you have an armada of ships sitting offshore waiting to supply a market. NNPC has done a great job in ensuring the market is supplied with products, but who needs it and at what price? The price of product offshore is much more expensive than the price of product in tank. So we're in that gradual phase of moving from a sort of regulated market into a deregulated market, which we'll talk about a bit later. But that transit point is really affecting significant demand. So for us as operators, the challenge is that how do we reduce our costs to be able to cope with tomorrow's market, which is going to be basically where the margins are going to be under significant pressure.
Thank you very much, Mr. Mahmood. So right now, buying crude at low price, and anyone who has capacity to store is king at this time. I'll take that on to Mr. Umar. Mr. Umar, Mr. George and Mr. Mahmood have talked about government intervention and government support. I'd like a perspective on government intervention specific now to ensure sustainable operations and preserve value in the industry as a whole, both upstream and downstream. What is government doing?
Thank you very much, Abisola, and thank you, everyone. Let me join my colleagues in appreciating PwC for bringing this discussion panel at this point in time. Indeed, it's very challenging for the whole industry globally, but for Nigeria, it's much more challenging in the sense that we're not only being hit by the low oil price driven by demand destruction and oil cuts from OPEC, but also the fact that we are among the highest operating cost operators in the industry, as well as debt burden, especially our independent companies in Nigeria. Now, governments in many countries are helping, and they should do so for reasons obviously known to everyone. Government's responsibility to protect jobs, and in particular to us in Nigeria, they need to also protect the banking system, because the oil industry the banking industry is heavily leveraged, more or less, on the oil and gas sector lending, and also to ensure that the overall economy is sustained in a positive manner that does not allow recession to set in. Now, how do governments help? Some governments are helping through tax waivers, but in the scenario we are in today, there's no profit. Where you're operating at a $30 cost and you're selling oil below 20, then there is no profit. And why there's no profit? So there's no tax. So if there's no tax, then there's no tax waiver. Secondly, on the debt burden, many of the countries have ability and surplus cash to throw in and support the industry. But in our case, the country itself is looking for bailout. We just recently got an approval from IMF, $3.4 billion, and we're also taking $80 billion from the domestic debt market. So clearly, there is no cash for government to intervene and support. What can government do in place? The way out is debt rescheduling. Many of these independents are heavily indebted to Nigerian banks. So through the Central Bank of Nigeria, government can step in to buy back the debt, reschedule it, and probably increase the interest rate, and then for these companies to pay back with their crude production when the oil price rebounds in months or years to come. So that's the potential. But the reality is that for sustainability of any operator in this industry lies heavily on its ability to curtail cost. So cost restructuring is imperative. We need to postpone projects that have not been started, or even those who have started that have a long gestation period can be postponed. We need to encourage vertical integration, collaboration, and cost pooling amongst partners. That way, some resilience can come in and to ensure they survive these hard times. Of course, debt rescheduling with their lenders is very key. Without that, it will be difficult that we might see bankruptcies, shutdowns, because there are no places where the crude will be stored anymore. And where there are job losses, there are attendant social crises to come with that. There will also be national budget deficits, because most of the revenue is expected to come from oil and gas. And if the oil and gas is struggling, the government will also be at it. And of course, that could also generate banking crisis when the upstream entities default, because most of the banks are really overburdened with oil and gas debt. So going forward, I think for the future, for us as a country, domestication of the economy is very important, adding value to whatever we do. Rather than exporting crude and bringing products, we should be exporting refined products. That means we have to rehabilitate and encourage new refineries, including the Dangote refinery. And then fertilizer, methanol, and what have you. Gas-based industrialization is key. We don't have to export gas only to be importing fertilizer. The second thing that we must do as a country is that we have to begin to sell our crude on a long-term basis to end users, not to spot traders who have no final destination for this product when they lift them. And therefore, we have to borrow what countries like Saudi are doing. They take equity stakes in refineries offshore such that there is every day a home for crude when it is produced, and it is beyond the internal requirement of the country. Again, the diversification of the economy is very obvious to everyone now that we can no longer rely on oil and gas as a country. So agriculture is a solution. Of course, we must learn to save for the future. We must educate National Assembly folks who don't believe that planning conservatively is good. You cannot be building a national budget at the peak of the market when you know that that price is not under your control. We're just price takers. So we have to avoid situations whereby we have nothing in the excess good account or the sovereign wealth fund. And finally, digital transformation, which a number of panelists have talked about. It is important that we encourage innovation that brings about operational efficiency, which brings costs down and therefore sustainability. Thank you, Abisola. Over to you.
Thank you very much, sir. You mentioned debt scheduling with lenders, curtailing cost, and then the government also creating an environment where industrialization is stimulated. Okay, I'll still stay with you, Mr. Omar. NNPC is a national oil company with operations in the downstream, upstream, and midstream. You play across the value chain. You're also a principal investor in the industry. What is your outlook for the Nigerian oil and gas sector if the impact of the pandemic takes another 18 months to resolve without a vaccine? What do you see?
Okay. Obviously, that would be very catastrophic because, as you heard from Mr. Edran, and we know globally now, there is no home for crude. The tankers are now being used as storages. So whether you like it or not, even if you want to produce, as suggested by Mr. Osahan, if you produce and there's no place to store it, you'll be forced to shut in. So when we shut in, this will drive bankruptcies because many of these companies can no longer afford their cost structures. There will be massive job losses. This not only in Nigeria, this will be global. There will be this overall deficit funding requirements by many countries, especially those oil and gas producing or countries that rely on oil and gas in Africa. And of course, the one that we also have to avoid is the banking crisis. When this heavy debt of about 3.7 or thereabout trillion owed the banks by the oil and gas industry in Nigeria, then you can imagine what will happen when those banks too are unable to deliver to depositors who have brought their funds into their custody. So it's a doomsday picture. We hope we don't get there. We believe that the cuts that will set in next tomorrow will begin to reduce the supply in the market. And with the gradual opening of our countries, we also expect that the demand will begin to pick up. And when that happens, we are likely to see a gradual rise in the oil price, at least to a level that many of these companies can break even. Thank you. Over to you, Bissell.
Thank you, Mr. Omar. So we're hoping that it doesn't get to 18 months. And we're hoping as we begin to ease the lockdown, demands increase. It might probably not get back to the post-COVID times, but it probably might help with the state of things. I'll come back to you, Mr. George. Mr. George, I mean, there have been discussions on the high cost of production in Nigeria. We talked about the weakening demand. We've talked about debt profiles and finite storage capacity. Do you see any opportunities? Is there any silver lining here? Do you see any opportunities for producers during this period? And what needs to be in place to make those opportunities a reality?
Well, opportunities come in various forms. I think being able to renegotiate your indebtedness to financial institutions will come in as an opportunity under this condition where we find ourselves. And of course, we did mention before about discussing rates and payment terms with your suppliers and service providers. Then on the other side, if you look at what's happening, quite a number of companies have started building their refineries in Nigeria. And we are saying don't undertake any serious or major investment at this time. I think when it comes to something like that, which is a linkage industry, that's going to give you a lot of advantages, maybe you shouldn't actually stop that one. So for me, I see companies, for example, the company that has its refinery on operation right now, it's not necessarily in seventh heaven, but it's a lot better than somebody that doesn't have a refinery. Because, of course, the usage of products are also at their lowest ebb right now. Then, even as we speak, some people are beginning to approach major operating companies to say, okay, look, let me buy your crude. Let me store it. I know that most of the vessels are being used for storage instead of transportation, but people are looking forward and saying, I'm going to buy your crude, buy it cheap, and I can use it when things turn around. The only thing is if you have a long-term agreement with the company to buy your crude, you probably won't be able to take advantage of that. But of course, why don't you keep these people warm? You never can tell for the rainy day. So there are opportunities here and there. It depends on the way you want to utilize it. Over to you, Bissell.
All right, thank you very much for that. Participants, I would like, if you have questions, to put it in the Q&A box so that at the end of the panel discussion, we can then pose your questions to the panelists. Mr. Mahmood, you've talked about the various issues within the downstream sector, especially since you're the tail end of that supply chain. For the downstream sector, do you see what's the future? What future do you see for that industry, for that sub-industry? And what steps do we need to take, particularly with the foreign exchange risk that you mentioned, the foreign exchange risk locking in the shadows?
Thank you. I think really what's important in the downstream sector, I think size is going to be very key. So I see consolidation in the sector because to be able to play in this sector, you must have a healthy balance sheet. So I think players will have to come together either by corporate transactions, M&A opportunities will be there, and certainly at the minimum, collaborative opportunities. Scale, cost, efficiency is going to be the driver. So can we get together and go forward to long-term planning? Mr. Ajio spoke about selling crude long-term. Can we buy products long-term? Because today the current model is very much spot. I see an opportunity, I'm looking for cargoes offshore Lomé quickly, and which traders has it, can I buy and bring in? we need to move to say, are we originating products from Europe? By the time the refineries come in, then are we buying into a refinery long term? So how do we collaborate to actually use our scale to be able to buy products on a larger scale and on better terms and conditions? So either unincorporated JVs, M&As coming through, and then of course I see NNPC playing a very strong role in the downstream. I think they're dominant right now, and they will continue to be dominant because one of the key factors is actually access to FX. So they have a natural hedge from their production operations, which they need to convert those dollars into a naira position. So I think their trading teams and the distribution arms will benefit from that natural hedge. So that's going to be a major exposure for us. The FX market is still not mature in terms of real deliverable futures. The futures market, the opportunities on the FMGQ is not really backed up. Can you say today that you know at what price you're going to buy FX tomorrow? As you probably know, FX today is moving at almost 500 naira to the dollar. That is 120 naira above what CBN is even quoting. And that CBN rate itself is a current adjusted rate, not necessarily a devalued rate. So the margins that we think we're making, are they really real? So I think for me, the sector, what I see is consolidation. That's very key. And cash is king. Whoever has access to cash will drive what happens in the market going forward. We've talked about technology, obviously. That's key. You can't take away technology. So technology, once you have cash and you can deploy technology to improve your efficiency and drive down your cost, I think those are going to be the key highlights of tomorrow's market. And the downstream sector actually poses, it's like a stress test for COVID-19. It's a sector that has enjoyed relative protection in some sorts because of semi-deregulation, semi-regulation, but now with the market being completely open, players have to now think about doing things properly and not just rely on prices or products being supplied at a specific price and margins being guaranteed. I think the era of a guaranteed margin is now off the table. Thank you.
Thank you very much, Mr. Mahmood. Thank you very much for that. So you talked about consolidation, collaboration. Adrian, you had mentioned a few of that in the past when you were doing your opening remarks. From your experience, how have companies survived these turbulent times in other climes?
Abisala, thank you. I think our esteemed clients have touched on a lot of these themes already, so I'm just going to build on them. So I think probably the most important point I'll make up front is the oil and gas sector is no stranger to downturn. So you think of all the price downturns that we've had, 2014, 2008, 2000, etc. There were many people, industry commentators, who in some cases prophesied the end of many participants in this sector. But somehow the sector has always survived and is quite resilient. And I think part of that is due to innovation. So I think on the one hand, I think companies, what they're doing now in terms of the focus on cost reduction, being much more efficient, preserving cash, I think those are certainly key elements to get through the initial phases that we're going through right now. We've talked a lot about innovation, whether it's technology or new ways of working. I think that's going to play a critical part. I think strategies need to be much more nimble now. If you think of the analogy of a yacht in turbulent seas and a train on a railway line, the train goes in a straight direction. The yacht has to tack, shift position, consistently being dynamic. I think just with the nature of the operating environment now and going forward, it's very difficult to have a strategy that is a 5 to 10 year outlook with the occasional review. Businesses need strategies that are dynamic and that are consistently being reviewed and adapted to a rapidly changing market environment. I think that will be a key element going forward. I think resilience of your business model is going to be so fundamental going forward. That resilience can go across a number of dimensions, but just a simple example, think about for an operator, how do you ensure that your supply chain is resilient in terms of the companies that are providing you services, what source of comfort can you identify to make sure that your suppliers can navigate major disruption? Will we need to think about moving away from global supply chains that can be occasionally heavily exposed to disruption, and think about bringing manufacturing capabilities a bit closer to where demand is in your supply chain? Does this mean, for example, back to technology that 3D printing, the ability to produce parts closer to your area's demand, that becomes much more important? And certainly, if you look at resilience in terms of portfolios, I think many companies will need to figure out how they can make their existing portfolio more resilient at a lower oil price going forward. And perhaps one of the speakers, I think it was Mahmoud, talked a lot about consolidation, and I totally agree with that. If you think of the last price downturn in 2000, that was the era when the super majors were created. I think once we get a bit of stability with the oil price, it's quite difficult to get valuations with such a volatile oil price now. But I think as prices begin to stabilize, you may see more consolidation, and scale will certainly be a benefit in this environment. And perhaps the last comment, I think what you will see also is, I think what we're seeing now just more broadly is greater government intervention in the market. And therefore the question then is, what can governments do to support the oil and gas industry? And there may be examples, for example, in the refining sector where governments defer excise duties on refiners to give them a little bit of breathing space to preserve cash flow. Do governments need to think about providing resilience packages to provide a stimulus to the oil and gas sector? And some of our speakers talked about renegotiating debt or helping service debt levels with their funders. I think there's probably going to be a bigger role that governments have to play to support the industry. But at the end of the day, the industry will find the solutions itself. Over to you, Abisola.
Thank you very much, Adrian. I'll go back to Mr. Omar. Mr. Omar, Mr. Tucker had actually mentioned that NNPC has to play a big role in the downstream sector. What strategy is being pursued by the NNPC to conserve the foreign currency or the foreign currency that is
You're breaking.
Okay, can you hear me clearly now? Okay, so I was going to ask the strategy that is being pursued by NNPC to conserve the much needed foreign currency to stimulate the economy. Are you looking at deregulation? And is there a plan on reviving the refinery?
Yes,
okay.
Yes, indeed. As you are probably quite aware, the central bank of Nigeria has federalized heavily. Yes. Can you hear me?
Yes, sir. Yes, sir, we can.
So what I was saying is that the oil and gas revenues had always primarily been the source of foreign exchange for Nigeria through the Central Bank of Nigeria. Now that the oil and gas revenues have dwindled significantly, to conserve the little inflows, the only way to do that is to try to maximize local content utilization in the whole industry. So this is not kind of pick and choose. Any procurement or contracting that is possible in Nigeria will be done in Nigeria using Naira cover. Encourage, as Mr. Osahon said, the rehabilitation of the refineries in order that we do not need FX to import products, nor do we need to exchange the crude for products. Secondly, we will need to encourage the utilization of CNG within the economy, such that this low-cost fuel can potentially, in the shortest possible time, reduce our demand for imported products, especially for vehicles that can easily be converted to use CNG. And I think whatever production that is available as a national oil company, we have also tried to go into short, quick forward sale agreements to bring FX into the CB and Kitty or forward sale of crude that we will have to give the crude over 5 years period. So that is the way we are moving to try to bring FX onto the table and support whatever FX needs are necessary for the industry, especially when it comes to cash costs, because when you're bringing revenues and the cash costs are almost equal, or even in certain cases higher than it's a tough challenge. So by and large, as a corporation that the nation relies upon, we are doing our best to try to bring couples of billions of dollars within the next 30 to 60 days through forward sales transactions, and that way we can probably support to some extent. Over to you, Abisola.
Thank you very much. Thank you very much, my panelists. I will then go over to questions from the participants. I have a question for Mr. Osaho now. Mr. Osaho, the first question is, you have talked about renegotiating contracts at this time. The first question is, the Nigerian service companies are the whipping boys in cost-cutting measures advocated by most operators. There was a slash in 2015 when the last downturn, and the operators are heading in the same direction. The question is this a sustainable strategy for the value chain? Cutting measures.
I think there are so many roads that lead to Rome, but some pass through Milan. I think the whole idea is to look at so many options you have to be able to survive. The issue affects everybody. It's not just the upstream. Everybody in the country, the whole economy is affected. But if people who are dependent on the upstream want to make money, that means that the operator himself has to make money. So cost cutting is a very critical part of it. Apart from what the companies themselves would do, that is the operating companies, their partners in business must be able to at least look at what they are doing and see whether they can assist them. And that's why I said all stakeholders must have their hands on deck to support the industry. And just like Adrian said, the industry has managed to survive, and they'll be able to survive all this while just because of such initiatives where everybody works together collaboratively to make things move. That's the way I look at it. Mr. Are you there?
Yes, I am. Thank you very much for that. The next question is to Mr. Tukur. What, in your view, will be the impact of the Dangote refinery on the structure and operation of the downstream sector in Nigeria?
Thank you. That's the million-dollar question that we're asking ourselves. I'm not sure everybody has an answer. Clearly, the fundamental shift is supply. So today, the entire market is supplied by imports. That should stop. The refinery should be able to supply the entire market and probably have access to exports into West Africa and other export markets. So what we expect to see is a major reduction, or let's say a complete eradication of imports into Nigeria. Now, will that also have an effect on, because products are locally produced, will he be selling in Naira? Will that then take away the demand, because they're a heavy sector user, a sector that uses FX heavily or demands FX heavily is the oil sector. So in terms of downstream and importation. So if we take that demand off the system, will that help the Naira appreciate? So in terms of supply, I think that's where we see the major disruption. In terms of distribution, people will still be loading products from those refineries, from the refinery, from the SBM, probably discharging into depots in strategic areas and continuing the normal trucking operations. I know NNPC is in discussions with the refinery with a view to maybe linking up to strategic pipelines. If the pipelines are built and the pipelines can be protected, and then therefore the integrity of being able to constantly deliver fuel from point A to point B, where people can now pick up at different strategic points instead of independent loading ships and distributing through their own depots, then clearly that will also have an effect on how the distribution will happen in the market going forward. Thank you.
Very much. So there's a possibility that there'll be appreciation of the currency, and obviously there'll be a supply disruption. Thank you very much for that. One of the questions I have here is to Mr. Omar. Mr. Omar, you had mentioned that there would be no tax rebate for players because they're not making profits. But then the question here is, what happens in the short term if prices pick up and players are able to make little profits? Would tax rebates and holidays then be considered as a cushion for the losses suffered now?
Thank you, Abisa. I think there's nothing that is off the table at this time. I said there's desperate times require desperate actions. So government is not quite unaware of the difficulties that the industry that used to bring the maximum revenue to it is in, and therefore anything that is put on the table can be considered. More so now that the government itself has gotten some bailout from IMF. So when a case is made before the finance authorities, it shouldn't be an issue that will not be considered. Knowing fully well that, okay, some of them are paying for corporate income tax, but those who are actually paying PPT, petroleum profit tax, that's where I was saying, in reality, there's no profit at all. So if there's no profit, there's no PPT. But for those who are under the farmer and cedar rules, then definitely it's a possibility when that is put on the table. Thank you.
Thank you very much for that. The question I have here is for Mr. George. Mr. George, the question is, we've seen this downturn. We saw this downturn in 2009 or 2008. We saw the shale boom crisis in 2014, where we had bankruptcies, huge impairments, revenue fall in the upstream, in the value chain of the oil and gas industry. The question is, we're now here again, and it's the same story. It's almost a case of when crude oil costs, we catch a cold. How can we build resilience for future downturn and black swan events like COVID-19?
The good thing is that it is on record that there's not a single operating company that went belly up during the 2008-2009 recession. But having said that, the dreams and aspirations of several companies were killed. And let me try to illustrate that. If you recall that about 60, 70 blocks were given out in the 2005-2007 licensing round. It took place every year for 3 years. And not long after that, you had this recession. Obviously, the financial institutions and partners or prospective partners became a lot more choosy, a lot more picky about which asset they want to support. So for now, at least as far as I know, out of God knows how many blocks were given out during that period, only one of them is on production today. So it is not impossible that such a thing will happen this time around. And that is why on the 7th of this month, when government revoked some marginal fields, the rumor in the rumor mill is that there will be new licensing round for marginal fields. And obviously the timing obviously is not the best. But having said that, even if you do it with this recession now, the same thing happened to all the 60, 70 blocks that were given out in 2005, 2007, may still happen to this new licensing round for marginal fields. But having said that, I think the easiest way to forestall unwanted consequences each time this type of thing happens is for government to have a strategy. I call it a crisis management. Because the price of crude oil is driven in part by geopolitical considerations, there's no time that this type of thing will not recur one way or the other. Two countries are having arguments among themselves, and the thing is affecting the price of crude oil. There's some labor thing happening somewhere, it affects the price of crude oil. So what government probably needs to do to make life easy for everybody is set up a strategy. Anytime the price of crude oil drops below a particular level, certain incentives will kick in automatically. Now, whether somebody is going to be the one pressing the button, the restart button or something, is a different matter entirely. But at least the initiatives are there. So if you cast your mind back, something obviously should have been done to help companies that got blocks about 13, 15 years ago, but nothing was done. And that is why those blocks are still there. So there has to be a trigger mechanism by which companies will be assisted so that this can go into operation and continue to sustain the system. Thank you.
Thank you very much for that. The other question I have is for Adrian. Adrian, I mean, what sort of services can PwC provide to mid-sized upstream and gas companies in difficult periods like this?
I think we can help in a number of ways. I think we can help in terms of supporting you in terms of improved cost reduction, helping you do that. We can help you in terms of supporting you with processes in place to mobilize a response to COVID-19 to protect and track your workforce. I think we can also play quite an important role in stakeholder mediation, so acting as the go-between between the lending organization and perhaps the national government in terms of finding mitigating reasons to support deferment of duties, examples such as that. And I think forward-looking, we can certainly help you in terms of thinking out how you may need to reshape your strategy, your business model to become more resilient in the future. I'll take a pause there, but just one quick comment. It was very interesting. One of the earlier questions around whipping boy seems to be a popular concept on this conference call, and it was the question around whether oil services are the whipping boys, and the answer is yes. And I've seen it in the North Sea and globally. There is typically there's an adversarial relationship between operators and oil service companies. When the price of oil goes up, it tends to be the service companies that have more sway, and when the price of oil goes down, it's more the operators. And I think that in the last price downturn, we saw a softening of that adversarial relationship and a greater willingness to cooperate. I think this downturn will reinforce that much more. So I'm hopeful that there will be much better collaboration between players, because at the end of the day, it is not in the interest of the industry to see oil service companies go bankrupt. They play a fundamental role in supporting the operators in extracting the oil and the gas, and it's in the interest of all players that we have a resilient supply chain. I'll stop there, Abisola.
Thank you very much, Adrian. The question I have now is to Mr. Mahmood. Mr. Mahmood, the question is this the appropriate time to formally deregulate the downstream sector? What are your thoughts on that before I then go to Mr. Umar?
Thank you, Bisola. This is a question after my heart. Deregulation, I would say, is 5 years too late. It should have happened. I was hoping, somebody asked me this question in 2015, and my answer was, my prayer was the incoming president then, President Buhari, in his May 29th, May 2015 speech, would have announced deregulation, because they had that opportunity then. Unfortunately, we missed it. So it's a great to have. It's the future. It's almost 5 years too late. We've spent a staggering amount of money to maintain price at 145. I think Mr. Ajay probably has a pretty good handle on that number, but I don't think it's a number we even want to talk about because it may make us cringe. The reality is that deregulation is not even a word we like to use. We never used to like to use subsidy. We called it under recovery. Deregulation, we're sort of tentatively mentioning. Some people don't like it because it's almost akin to government has abandoned its people. You've now left the Nigerian populace to, the market frenzies. But I think deregulation is great. It's going to help NNPC, first of all, or the Nigerian government and NNPC, stop the wastage of, using crude to supply products at a subsidized rate. That's very key, because then all that revenue that is required for the country all those barrels can be sold on a long-term basis. To me, it's the best thing that has happened or will happen to Nigeria this year and going forward. It will certainly help. It will reduce the subsidy of petroleum products across the border. It will ensure that the market is actually supplied what it requires, and I think you will see volumes, a right sizing of volumes. So, the 45, 50 million liters that are currently being supplied in may end up in about 30 million liters, but those numbers we'll see. I think demand will drive that. You have things in the works along like industry restructuring. So what is the future for the organizations like PEF, of organizations like PPPRA? Because you have a multiplicity of government functions. So PIGB envisages some sort of restructuring and consolidation. For us as operators, multiple points of cost. So you go to DPR, you obtain permits, you go to PPPRA, similar permits, you contribute a large amount of funds to PEF for equal distribution of petroleum products. Somebody joked the price of Coca-Cola in Abuja is the same as it is in Lagos. So let's find a way of ensuring that petroleum product prices don't necessarily need to be uniform from Abuja to Lagos. Market should determine that. So I think there'll be a lot of benefits to government in terms of cost savings. And then you have even the soft issues. How much time do we spend going before the National Assembly, for example, defending ourselves, both us and the operators, and the regulators, one way, shape, or form, one probe, one inquiry. So all of those things will be taken off the table. We'll focus on real business. So deregulation for me is fantastic. It's what is required, and long-term, the country will benefit. You probably saw the 2020 budget. How much was budgeted for under recovery versus the consolidated total budget of health and infrastructure and other important critical areas that we could not fund? So as far as I'm concerned, I'm very grateful that the market is down in that sense, and the government and NNPC has seized the initiative to say we're not looking back. Let's open up the market and let the market be dictated by market mechanisms rather than some sort of futile protectionism, which ultimately doesn't benefit the people whom it is intended to. Thank you.
Thank you, Mr. Mahmood. Mr. Umar, do you have any comments to add to that?
Thank you, Arizala. I think well said by Mahmood. The reality is that as far as we are concerned, the market is liberalized. So let me use the word deregulated, is liberalized. Marketers can import and sell. I think the only challenge he had alluded to earlier in his opening remarks is that CBN needs to step in now to support them with FX to be able to import and compete in the market. We as NMPC, as a national body responsible for protection of energy security, we will only intervene when we foresee shortages, potential shortages in the market, or where we see prohibitive profiteering by marketers in order to protect Nigerians. So we are happy, and that will protect the nation from those revenues that are being wasted to augment the pricing, and that maybe this also brings an end to all these endless claims by marketers about subsidy claims. Thank you.
Thank you very much for that. Thank you very much for that. I would now go through the panelists to then talk for your final comments. I just have a question here, which I think, Mr. Omar, you've already answered. Someone is saying, please, can the industry have a rebate on government royalties? Mr. Omar, that is for you. If you have just like a minute to just talk about that.
I think the PIB is in top gear. That will provide the reality in terms of clarity and what have you with respect to the fiscals. And if not for the lockdown, and I'm pretty sure it would have reached the National Assembly now, and they too have promised to vigorously deal with it and pass it into law as quickly as possible. So rebate and royalty, I think we just had the DOA for the deep offshore activities amendment, and for the other shallow and onshore operators, I think the PIB will handle that comprehensively. So let's wait and see. But reality, government is very sensitive to competitiveness with respect to applicable fiscals that are operating in other jurisdictions, because we needed to be competitive to attract FDI. Thank you.
Thank you very much for that. So in closing, we would have 1 minute each for your final comments. I want to thank everybody who has sent in their questions. I do apologize, we're not able to take all questions. But I will then start with Mr. George. Mr. George, your final comment.
Okay, my final comment will be for major operating companies and small ones, you don't stop production. That is 1. 2, manage your crew change very well so that you don't run into trouble with respect to transmitting COVID-19 among your workforce. 3, keep your staff strength as much as you can, making sure that where you can pay them, you pay them, where you need to discuss with them on some kind of reduction of their salary so that you can continue to carry them along. That is fine, because putting them out of work will put pressure on the society and invariably government with respect to getting people to work. And more importantly, the industry itself must embrace technology going forward. We don't have a choice. And government needs to, I don't know about royalties, because royalties must go through the National Assembly. But there are so many deductions being paid by upstream companies, which must be relaxed so that they have a little bit of relief. Thank you very much.
Thank you for that. Mr. Mahmoud, your final comment.
Thank you. My final comments from the downstream perspective, where we've come through, I think 2019, I would say, was probably the worst year in downstream. So companies' margins were totally eroded. We have massive FX exposure, so we need support from the government and from CBN in ensuring that we are able to perform our role in terms of energy security and producing and delivering products at the last mile. For us to comfortably do that, we need FX support, because the exposure we have today is unprecedented. Companies could go out of business, are in the process of going out of business. Mr. Ajia mentioned endless subsidy claims. We still have open claims today. So in an era where government is now moving towards full deregulation and closing that chapter on subsidy era, then please, I appeal to government also is that marketers are still owed a lot of money, sitting in all kinds of various approval stages. We need these monies paid. We need our cash flow back because we have performed services. We have met contractual obligations, and the government, on the other hand, has delayed payments. So we have an appeal to have our payments made. And I think, going forward, the downstream sector just needs that support. We need that transparency, and I think we're a little bit over-regulated. So government agencies have seen the downstream sector as areas where they can generate revenue. So from NAFDAC to DPR to PPPR, all these agencies, you can't basically jump without paying 6 or 7 different licenses for a very similar service. And of course, if you don't pay it, you can't get into business. So that creates inefficiency and also creates cost structures that are unsustainable going forward. Thank you.
Thank you, Mr. Mahmood. Final comment for you from you, Adrian.
Thank you. I'd say focus on the short to medium term, focus on cash, ensure that you have strong cash flow, focus on collaboration across the industry, because I think with collaboration, we can navigate this turbulence, double down on technology and innovation for all the reasons that we've mentioned. And I think as we move from the immediate impact of the crisis, which is very much the mobilize, as we move into the second phase, which is the stabilize part of the crisis, I think companies need to start thinking about how they make their business models more resilient. Thanks, Abisada.
Thank you very much. Mr. Umar, your final comment.
Thank you very much. So on my side, I think what is important for us as a country is the diversification of the economy, agriculture. That's number one. Number two, we must begin to save for the future because the price lump will come back again because we don't control the price. We're a price taker. 3, we must domesticate our economy, refine what we consume, and gas-based industrialization. 4thly, digital transformation. The whole world is moving towards that post-COVID-19. 5, companies must learn to embrace M&A, vertical integration, collaboration, and cost pooling. And finally, entities must also reschedule their debt burden and sustain their operations. Thank you.
Thank you so much, Mr. Umar. That was great. That was very insightful, very enlightening. I think we have all learned a lot and a lot of takeaways from this session. I want to say a big thank you for coming, for joining, and for sharing your words of wisdom. I would then pass this on to my colleague, Oluwadamilola Dada. She would then take the wrap up, the survey findings, and then do a close for us. Thank you very much.
Thank you very much. Thank you, Abisola. Good afternoon, everyone. Damilola Dada here. As part of the registration for this webinar, we conducted a survey. We had over 400 respondents cutting across the oil and gas industry, financial institutions, legal services, and other industries. And I would like to share with you some major findings from this survey, which reinforces some of the points made earlier. 70% of the respondents think COVID-19 pandemic will last longer than 6 months. The most common concerns relating to the pandemic are the crashed oil prices and depressed demand. Business sustainability and liquidity are the major risks in this challenging time. As for the range for cost of production, $15 to $25 was the most common. Lastly, the common initiatives that companies are considering are increasing or implementing cost optimization, developing new work practices, and deferring or canceling planned investments. Please note that we can email these survey findings to you and other materials from the webinar. Before we proceed further, please let us acknowledge the lives lost locally and globally due to COVID-19. May their souls rest in peace. Also, we want to appreciate the healthcare workers and everyone contributing to reducing the spread of the virus. I hope you agree with me that this has been insightful and time well spent. The key messages that I have taken are companies can preserve value in these challenging times by debt rescheduling, digital transformation, better FX management, collaboration with other players, and we cannot forget social efforts during this pandemic, such as testing for offshore personnel. I want to sincerely thank each of our panelists, Mr. Umar Ajia, CFO of NNPC, Mr. George Osaon, Chairman of Enagia, Mr. Mahmoud Tukur, MD of Itana, and Adrian Delmestro, Director from PwC UK, for their tremendous contribution and sharing their perspectives. I also want to appreciate everyone else for joining this webinar and for asking questions. The questions were value-adding. I would like to inform you that we have a power webinar today at 4 p.m. and we invite you to please join. The theme is COVID-19 and the power sector with a focus on macroeconomics, consumer purchasing power, and cost-reflective tariff. The speakers in no particular order are Mr. Eyo Epo, Director of New Frontiers Development Limited, Dr. George Oluwande, Managing Consultant of Abyssal Consultants Limited, Mr. Ahmad Zakari, Special Advisor to the President on Infrastructure, Mrs. Funke Oshibodu, CEO, Benin Electricity Distribution Company, and lastly, Mr. Ebikbere Clark, Special Advisor to the Governor of Central Bank of Nigeria on Energy. It is going to be a great session. Also, we hope you look out for our subsequent thought leadership events. Thank you once again for joining PwC Oil and Gas webinar. Please enjoy the rest of your day and stay safe.